Welcome to Between the Lines, the podcast that brings you deep insights into the evolving reinsurance landscape across Asia Pacific. I'm Andrew Mullen, Deputy Editor, stepping in for regular host Mithun Varkey. We're recording here in the Hong Kong newsroom of InsuranceAsia News. Join us as we unpack the week's biggest headlines and preview the stories shaping the market ahead. Also on the podcast this week, we will hear from Marc Burban, CEO and founder of Asian Risks Management Services. Marc has been a property and casualty underwriter in various insurance and reinsurance companies for about 15 years. He also recently penned a comment piece for us, reflecting on the deadly explosion at a fireworks factory in China in May. And he joins us on the podcast to discuss the Chinese insurance market from a claims, pricing and penetration level perspective at a time the country is facing the threat from several NatCats.
Few years ago, depending, so it was like a cycle. Some companies, they were looking for business, so they were very flexible. However, now it changed a lot, and the reason is because of the regulations. And so in practice, it means that the insurers are not just looking for premium, they are looking for profitability. So that's the big change we've seen probably, I think, 1 or 2 years ago. So it's not a cycle, it's more like a trend.
Joining me in this episode is the InsuranceAsia News editorial team of senior correspondent Aidan Gregory and reporters Joana Nguyen and Roshan Nambiar. Welcome, everyone.
Thanks, Andrew.
Let's get started. The big story dominating the news this week has been the earthquake in Japan. We have already seen several estimates on the potential damage, and our team has done a fair bit of reporting to find the real impact of this latest earthquake to hit Japan.
Right. So last week, the Kumamoto region in southwestern Japan was struck with a 7.1 magnitude earthquake, killing at least 36 people and damaging thousands of homes as well as many manufacturing bases. So the insurance industry has had some early estimations on the amount of insured losses. For example, Aon expected less than 1 trillion Japanese yen or $6.7 billion in insured losses. Meanwhile, Japanese loss adjuster VRS Uchiyama JV tell us that the payout could be between 2 to 5 billion US dollars. So overall, the losses are expected to be less than those from an earthquake of similar magnitude that struck the region a decade ago.
Thanks, Joana. But from what our reporting says, the key point is not the absolute loss in terms of the financial value, but the potential impact on manufacturing operations, logistics, network, supply chains, that kind of thing.
Exactly. So Kyushu, the one of Japan's main islands where the earthquake occurred this time, is a major manufacturing hub for motor and semiconductor sectors. Therefore, losses may extend beyond, direct damage to factories and equipment to, business interruption claims because of shutdowns as well as disruptions to logistics networks following this earthquake. For example, local media has already reported that automakers like Toyota, Nissan, or Daihatsu have extended their suspension periods of their plant operations and production of some models until this Friday because of parts of the supply disruptions due to this earthquake. However, some other loss adjusters like McLaren's and Crawford say that after the earthquake 10 years ago, the industrial facilities in this region have made significant improvements in seismic design standards, as well as business continuity planning, so that they are also expected to be better positioned to withstand the event.
Thanks, Joana. So we have a lot of stories already online about this topic, and I'm sure there's going to be many more in the coming days and weeks as the story develops. But as you can see, it's still premature to make a final assessment of the loss impact. But given the region houses many chip manufacturers and other commercial facility bases, this is not an earthquake that the industry can afford to overlook. Another one of our most read stories the last week, the cyber attack on Australian power and gas provider Origin Energy. This also has deeper implications for the insurance industry.
Indeed, this is an evolving story still. But Origin Energy is the latest high-profile data breach in Australia. And we did quite an extensive story, which came out on Monday this week, about what the potential payout is going to look like. Many senior cyber market sources think that it's likely to top $100 million and signal a potential tightening in the Australian cyber insurance market. We've been monitoring this one quite closely, and Origin Energy has confirmed the existence of an extensive cyber insurance program, which is underwritten by a panel of Lloyd's and Australian insurers. This panel is, according to sources, it includes CFC and was broked by Aon. The final size of the payout will depend on Origin Energy's policy limit, and also obviously the expected losses, which will depend on a number of things, including possible regulatory action and the financial damage associated with the data breach. So it's still an evolving situation. It's likely to develop into quite a lengthy and protracted claims process, just given how complicated the nature of this situation is. And it's worth mentioning too that Origin Energy is a listed company, which comes with many different disclosure and regulatory requirements that makes it more complicated even further.
Yeah, another one where we're going to see more reporting in the coming days and weeks. Sticking with Australia, there's been some developments in the M&A sphere.
Yeah, so Tokyo Marine is reportedly eyeing a major acquisition in Australia, with IAG and Suncorp named as the possible targets. Reports say that Tokyo Marine wants to put excess capital to work, while any deal could face regulatory and political hurdles, especially if Suncorp is involved. Tokyo Marine has declined to comment, and neither IAG or Suncorp have responded to some of our queries. Another deal this week that made some progress was the deal from Amwins, Dragoneer and KKR in relation to their proposal to acquire Steadfast. So Steadfast this week said that the consortium of Amwins, Dragoneer and KKR has substantially completed its due diligence on the Australian dollar 7.7 billion takeover offer. The exclusivity period now runs until August 19th, but Steadfast says there's still no guarantee a binding deal will be signed. Continuing with Steadfast, the Australasia broking CEO Tim Matheson has departed the firm. Matheson was also named acting chief executive officer and managing director, while Robert Kelly stood down temporarily earlier this year during an investigation into a workplace complaint.
Yeah, busy time for Steadfast. And just a reminder that you mentioned Robert Kelly. He has again confirmed his intention to retire. So there's going to be a lot of changes with Steadfast at that senior leadership level, and especially if there is this takeover, this acquisition does go through. Moving on and sticking with Australia, Allianz has also been in the news this week.
Right. So the Australian competition regulator ACCC has cleared Allianz Partners' proposed acquisition of NIP's Australia and New Zealand travel insurance portfolio. The deal will cost Allianz Partners up to $35 million and is expected to set it as a leading player in the Australia's travel insurance sector. And then sticking with Allianz, but moving to Singapore. So Allianz Group has agreed to acquire 100% of HSBC Life Singapore for $2.1 billion. This is part of a $2.3 billion deal that includes a 15-year exclusive distribution arrangement. And this is subject to regulatory approval and is expected to close in the first half of 2027.
Yeah, and it's not just Australia and Singapore. There's a couple of big deals gone through in Malaysia this week as well.
This week, Maybank, one of the biggest Malaysian banks, has reached a deal to buy out Ageas, the Belgian insurer, from Etika, which has been their joint venture for insurance in Malaysia since 2001. And Maybank has agreed to buy Ageas's 30.1% stake in Etika for $1.2 billion. So it's quite a sizable deal. And it means that Maybank will take full control of Etika, which had been a joint venture since 2001. So it's essentially Ageas calling time on its time in Malaysia. The Belgian insurer has reiterated its commitment to the broader Asian market, but it is getting quite a good price for its stake in Etika. It's 1.98 times book value and 15.3 times its earnings for the 2025 financial year. The deal is subject to regulatory approval and it's expected to close later in 2026.
Also this week, the parent company of Malaysian Re, MNRB Holdings, has struck a deal to sell its Takaful business to Bank Rakyat, the Islamic cooperative bank, for $400 million subject to regulatory approval. And this divestment is part of an effort by MNRB to reshape its investment portfolio in accordance with its long-term strategic priorities, including refocusing on its core reinsurance and re-takaful business.
And not to be left out, it's probably been the busiest in India recently, where the insurance industry has continued its recent growth spurt.
To start, MS First Capital has received a branch license for India's Gift City, making it the latest international insurer to enter the hub. The MS&AD-owned Singapore carrier got approval on July 1st and will be led locally by reinsurance head Vaidyanathan Ramachandran. With MS First Capital joining Gift City, the total number of IFSC insurance offices has risen to 38, including 23 international carriers in Gift City. So continuing with IRDAI, the regulator has approved Patanjali Ayurved and DS Group's acquisition of Magma General Insurance in a deal worth around $470 million. The purchase gives Patanjali a first entry into general insurance and marks the sign of consolidation in India's fast-opening insurance market. Moving on, private equity firm Bain Capital is reportedly in talks to buy up to a 25% stake in Indus General Insurance in a deal that could value the insurer at about $1.67 billion. If completed, it will be Bain's first direct investment in India's general insurance market as private equity interest in the sector continues to grow. And Blackstone, another private equity firm, is reportedly entering India's general insurance market with former HDFC Ergo chief Anuj Tyagi. The new venture, Nextshore, has applied to IRDAI for approval and would be majority owned by Blackstone as foreign capital rushes into the sector after India opened its insurance to 100% FDI.
Thanks, Roshan. So yeah, certainly exciting time in India, and as Mithun put in his recent full capacity newsletter, India is certainly the hottest ticket in town in terms of insurance. Finally, onto the stories that we're all working on. What's on the calendar for the next few weeks?
Coincidentally, with all the stuff that's been going on with Origin Energy, I've actually been looking into the state of the cyber market in Asia Pacific and whether we are sort of at a turning point in terms of the trajectory of cyber insurance rates. The market obviously has been super soft, but there is a growing feeling that the current rate environment doesn't quite match up with the rapidly escalating nature of cyber threats across the region, particularly with all the the geopolitical volatility that we've been seeing, and we also have the rise of AI technologies, which has started a huge arms race in the cybersecurity industry between threat actors and cybersecurity professionals. So that should be quite an interesting read, particularly in the context of the the major cyber events that we've seen recently.
So last week, Roshan published a story about the impact of El Nino on agricultural insurance. And in particular, India has a very strong agricultural sector, and it has the third largest agricultural reinsurance portfolio across the world. So I really want to look into this, especially given that El Nino is intensified.
From my end, I'll be looking at how the decommissioning insurance market is evolving around Asia Pacific as aging energy assets approach the end of their life, including some recent events such as Australia's Cliffhead case off the coast of Western Australia. I'll be reaching out to ask about changes in pricing, capacity, and policy terms, as well as maybe some underwriting challenges around weaker operators and how regulators around the region are shaping the financial assurance and long-tail liabilities.
So yeah, it sounds like there's a lot to work on, obviously, with the Origin Energy cyber breach. We've got the earthquake and those stories you just mentioned. So it's going to be an exciting few more weeks. And as Mithun would say, let's get back to work.
Thanks a lot, Andrew. Thanks, everyone.
In this episode, we are joined by Marc Burban, CEO and founder of China-based broker Asian Risks Management Services. The company is a specialist in cross-border insurance, supporting Chinese enterprises when they expand overseas. Marc will give insights on Chinese general insurance markets, as well as the opportunities for domestic and international reinsurers amid more frequent NatCat events. Also, as the country has witnessed several losses related to factory fires recently, Marc will shed light on the challenges of risk management in the world's largest manufacturing base. Listen in.
Hello, Marc. Welcome to Between the Lines. It's a pleasure to have you with us.
Okay, thank you very much to invite me for this meeting, this conversation.
To start off, can you tell us a little bit about yourself? You've been in China for over 2 decades. What brought you to China? How did you end up starting Asian Risk Management Services? And what does ARMS do?
Mm-hmm. Okay, so basically I'm from France and I've been a property underwriter for many years in France. And I work in the reinsurance industry. I experienced the World Trade Center event in 2001. I don't know if you remember, it was pretty shocking event for the reinsurance community. And a lot of reinsurance companies went bankrupt. So at that time, I was less than 40. And I said to myself, I won't stay in this business for too long because, I don't want to be laid off after 50. So because I was still young and I was doing like international business, I said to myself, okay, I should do something else and leaving my company when I'm young and try to do something else, another business. And it turned out that the Chinese market, insurance market seems to me very promising. So I decided to come to China and I started as loss adjuster. I came in 2003 as loss adjuster. Then in 2010, I started to work as an insurance broker first. As partner with a company. And in 2017, I founded my own company, Asian Risk Management Services, ARMS. So with the objective of helping companies better manage their risk both in China and outside of China. So we are an independent insurance broker with offices in Beijing and Shanghai. And our main areas of expertise are property insurance, liability insurance, trade credit insurance, and also medical insurance. We work with a wide range of clients from individuals to small to medium-sized enterprise. So it's our focus. We are not working with large, the big company. Today, the growing part of our business is supporting Chinese company as they expand overseas. At the same time, we are helping international company operating in China navigate to the local insurance market. So I would say that our niche is cross-border insurance. So we understand the Chinese insurance market, and at the same time, we have the network to support our clients wherever they operate outside of China. So, and in addition to that, we've built a strong relationship with insurance company and local partner across Africa through the project we handle in the continent. So this allows us to support Chinese company investing across the continent by arranging a local insurance solution with a reliable partner.
The Chinese insurance market is quite interesting in itself. What we've seen, especially as we speak, and some of our conversations started around the sort of losses that we've seen in China of late, both risk losses and nat cat losses. Especially in July, we've seen severe nat cat events. Given the exposure to perils that China has, how do you see the market in terms of claims, rates, in terms of the opportunities there?
Mm-hmm. Well, so China is facing a new reality, So natural catastrophe events are becoming more frequent, more severe, particularly floodings, heat waves, and also storm. For the insurance industry, the impact can be seen in three areas: claims, pricing, and insurance penetration. So first, let me start with claims. So interestingly, 2026 has been a relatively moderate years for catastrophe losses globally. But Asia and China in particular has been an exception. So according, for instance, to Aeon's catastrophe recap for the first half of 2026, seasonal flooding in China generates about 5 billion of economic losses. Yet around only 100 million was insured. So what we are seeing is not necessarily record-breaking catastrophe every year. Instead, it's more like a succession of mid-sized storm, floods, or other weather events that continue to generate losses throughout the year, which is an issue for our insurer and reinsurer, actually. From our perspective as broker in China, we see that many companies, particularly small to medium-sized companies, either remain uninsured or carry limits that are no longer adequate for today's catastrophe exposure. When it comes to pricing I will not describe the Chinese market as entering a traditional hard market where, premium simply rise across the board. Instead, what we are seeing is much more a technical approach to underwriting. Insurers are paying closer attention to flood exposure, drainage system, elevation construction quality, and increasingly the insurance on loss prevention and business continuity. So at the same time, a regulator develop new ways of transfer risk, catastrophic risk. The National Financial Regulatory Administration has support development catastrophe link security through Hong Kong, while parametric are gradually emerging for certain public sector and catastrophe risk. So I think that the market is not just simply charging more for catastrophic risk. It's learning how to understand and price the risk much more accurately. However, when we speak with clients, we see that many of them underestimate the catastrophe exposure. Flood risk, in particular, is often viewed as low probability risk. So the most important is developing risk awareness in China. It's probably much important to develop that only insurance products to make sure that the people, the insurance, the businesses understand the risk and are taking the right measure to prevent the occurrence of this kind of risk, or at least reducing the severity of a risk.
I just wanted to bring you to the point about, you mentioned about the pricing. In some ways, Chinese market isn't always in lockstep with the rest of the world. As in, we went through that massive hard cycle a couple of years. Some of the people in the market said China didn't go through that similar level of hardening. And now we're in a softening market. Are we seeing a similar softening in China? Is there a Chinese market pricing dynamics is slightly different from the rest of the world?
I think it's different from the rest of the world. There is no, I think at some stage I would say that China is decoupled from the rest of the world. It has its own dynamic. So a few years ago, so it was like a cycle. Some companies, they were looking for business. So they were very flexible and with very soft conditions. However, now it changed a lot. And the reason is because of the regulations. So the National Financial and Regulatory Administration has implemented a new regulation asking to company to stick stricter to their actual assumption. And so in practice, it means that the insurers are not just looking for premium, they are looking for profitability. So that's the big change we've seen probably, I think, 1 or 2 years ago. So it's not a cycle, it's more like a trend. Seeing that the insurance company in China are more technical, developing better assessments of the risk, and it's just geared by the regulation. And the reason is because, as I mentioned, there is underinsurance in China, and the regulator is very concerned about if the insurance penetration, if the insurance coverage level increase, it will increase the cost of the claim. So the regulator wants to make sure that the company are solvent to pay the claim. So this is why as they are asking to have a better management of their pricing and underwriting decision.
That's quite interesting. It's kind of decoupled from the rest of the world, that cycles don't affect the Chinese market as much. We've seen quite a few headlines, certainly this year, about big risk losses, factory fires. Are you seeing any particular trends around risk losses?
When we talk about fire factory in China, I think it's important to understand that the biggest challenge is not the fire itself. It's more the concentration of risk. So China has built some of the world's largest manufacturing cluster. Today, a single incident can cause not only a property damage, but also business interruption and disruption throughout the global supply chains. For instance, the Jinko Solar event in 2024, it's a good example. The property damage was estimated at probably something like 670 million. However, the issue for the company has to reorganize the production to minimize disruption, so basically business interruption. More recently, we have seen, like as you said, so this year, for instance, tragic events such as the Huaiteng shoes factory fire and the firework factory explosion in Luoyang. So, although this incident occurred in a very different industry, they all highlight the same reality. As China manufacturing become more advanced, risk profile is becoming more complex. One of the biggest challenge, in my view, is not the lack of regulation in China. China has already a comprehensive safety standard. It's more the challenge is to make sure that those standards are constantly implemented and maintained. Investigation into major industrial accident often show that known deficiency has been identified before the event, but they were not fully addressed. So another important issue in China is the rapid urbanization of China past two decades. So many factories that were built originally on the outskirts of city are now surrounded by residential community, schools, commercial development, shopping mall. So that fundamentally changed the nature of the risk. Factory fire is no longer only a property or business interruption event. It can quickly become a major liability event with injuries, fatalities, environmental damage, and significant impact on the neighboring community. For instance, the Luoyang firework explosion is a reminder that the consequence of an industrial accident can now extend far beyond the factory, because the surrounding neighborhoods was impacted by these events. So at the same time, manufacturing is evolving very quickly. Industries such as photovoltaic manufacturing, lithium battery, electrical vehicles, and semiconductor rely on highly automated production lines, expensive equipment, and in some cases, entirely new fire, such as our battery thermal runaway, is one of the new emerging risks for the industry, such as EV, electrical vehicles, energy storage. So fire today is not just simply rebuilding a building. It can also stop the production for months, interrupt global supply chains, and create business losses that are often longer than physical damage. So from our experience placing industrial risk in China, we see that investment in the production capacity doesn't always progress, not at the same pace as investment in risk engineering. So company invest in the latest manufacturing technology, but fire protection, compartmentalization, and business continuity plan don't always keep the same pace. That's where the insurance industry can create value, not simply by paying claims, but also by helping clients to reduce the likelihood of and severity of loss before they happen. We are also seeing insurers becoming more technical in their underwriting. 10 years ago, two factories producing exactly the same product might have received the same similar insurance term. Today, it's not the case. Insurers are really looking at the particular of the risk, making a proper assessment of if the risk is well maintained, if there is good safety devices installed to fight fire, and also good risk engineering plan.
I think there's two things here. One is that there is an aggregation of risk because of the large scale of the factories and industrial clusters, but also at the same time we're also seeing more technical underwriting from the insurers. Is that correct? Insurers are becoming more aware and more demanding in their underwriting standards. There's more maturity on the side of the underwriters and brokers, you feel, in China?
So, I've been in this business as an insurance broker for 15 years. I see now the insurers are more technical. And for us, when we approach insurer to place business, they have really technical questions. It's not just a matter of premium. It's really something that comes from the top, the headquarters of the company. Insurer place profitability first.
You do a lot of cross-border work with Chinese companies going out, as well as foreign investments coming into China. Are there any specific trends that you're seeing from the Chinese market from a cross-border perspective?
It's really case by case, depending of the project, depending of the coverage. If it's a country where there is no natural catastrophe, Chinese insurers may cover on their own, If the same insurer, so if there is nat cat exposure, so they will ask for reinsurance. Also, the size of the project, if we are talking, I would say less than $100 million. So the Chinese insurer can take up the project. It's not a very big issue. Above 100 million, they will ask for reinsurance. And also the coverage. For instance, if it's like a traditional CAR for standard project, we have, for instance, one of our latest projects was a wind farm in Serbia. So it was taken up by a Chinese company. But if it's a larger project, let's say we've seen, for instance, hydropower plants in Africa. So in this case, we need to place also reinsurance. One of the issue in China is, and it's something that we sometimes place in Africa, for instance, is defect liability. So in Africa, especially in the west of Africa, French-speaking part, they are using the same system in France is decennial liability, which means you provide coverage for 10 years for some project like roads, construction. Chinese insurers, they don't do that. So for this kind of coverage, we are using international market. Yeah.
Do you see more innovation happening in the Chinese market?
So in terms of demand, for instance, for product liability, there is a market, there is demand. There is few insurers in China that has the appetite and also the technical expertise. So it's quite difficult to place. And I don't see Chinese insurer, local insurer doing that in the coming years, because it's quite, you have to have the expertise. And the volume of business is not as big as it is for some other part. However, I didn't say that the market is quite innovative in many ways. First, development of the technology, the risk in China. So the Chinese insurer has to adapt to understand your risk. As I mentioned, the risk related to electrical vehicles, new manufacturing for battery and so on and so forth. So the issue is there is no historical claim data for this kind of new manufacturing activity. So the Chinese insurer, they need expertise from the reinsurer and international reinsurer to build up models to understand the risk. The key point in China, they are not just digesting insurance distribution. They are using new technology throughout the insurance chain. So, for instance, we are seeing artificial intelligence helping underwriter to analyze and write a complex risk. And it's not today. I mean, I have seen that probably like 4-5 years ago. They already start to use AI to write risk. And also using cognition to accelerate claim assessment, connected device providing real-time risk monitoring in factory and commercial buildings. So evolution is happening at a remarkable speed, and is changing how insurers price and manage the risk. So I would say in terms of coverage, the insurers are pretty conservative. For liability, property, they have to adjust to their market. And when it comes to the use of new technology for their day-to-day business, they are quite innovative.
What are the sort of opportunities for both domestic and international reinsurers in China, in developing some of these products?
So I see, there are a few areas where reinsurers may have impact or have an opportunity in China. First, natural catastrophe. Once again, the market is underinsured. There is low penetration. So the Chinese insurer, they need modeling capacity, capability to understand how to rate the risk. So that's an issue, one part for the Chinese, for the internal reinsurer. So a part offering capacity is also providing a technical capability such as modeling and risk management. Second is also, for the new technology manufacturing. So where there is not a very long historical claim data, insurers, they need to have models to understand the risk. And that's something that international reinsurer can bring some expertise from the outside of China.
Thanks, Mark. I mean, that's all the questions I have for you. Thank you very much for joining us. It was a pleasure to have you.
That's all for this edition of Between the Lines. Thank you for joining us once again. Don't forget to subscribe to our daily and weekly newsletters to keep you informed. And also find us at insuranceasianews.com. My name is Andrew Mullen. Bye for now.